Hey guys, Toby Mathis here, and today we're going to be talking about how do I protect myself against a real estate crash. So let's dive right into it. First off, do I think there's a real estate bubble that's going to burst anytime soon? The answer is actually statistically no. We're still underbuilt. Housing has gone up considerably, and people liken it to 2006, like here's this big storm's coming. We're just inflated. Everybody's fighting over houses. 2007, it reaches its peak and then pop. But we're nothing like that. We didn't have a Fed who was literally buying up all of those securities, like all of the mortgage-backed securities. That's what's happening now. Before that was the market, and they were liar loans and all those other things. Now, I can tell you, as somebody who deals in real estate all the time, it's really, really difficult to get traditional mortgages right now. When I say it's difficult, for those people that used to get them easily, and they called them liar loans and stated income loans, it's become much, much tighter. Now, that may loosen depending on what goes on with the Fed as we see the interest rates start to rise. But I could tell you it was like really, really difficult over the last few years. I know because I've been doing this for over 25 years. Some mortgage people might want to argue about it, but I could tell you that you could get a loan in 2007 that'd go like this. How much did you make? They'd fill it out for you, no verification, and you'd get a loan. And there was tons of people that were doing it. In my neck of the woods here in Las Vegas, we saw our property values lose 75% of their value. So, how do we protect against it if it happens again? I don't think it's coming anytime soon, but you got a Fed who's going to be raising interest rates. As we sit right now, we have lightning inflation. It is hot, it is smoldering. It is it's on everybody's mind. And how do we combat it? We're going to have to push it down, we're going to have to squelch it with some inflation or with some interest rate hikes from the Fed. So, how many are they going to do? How long, how hard are they going to go? Anybody's guess. The markets are baking in a certain number, but we know that the Fed kind of does whatever the heck it wants to do. Do not fight the Fed, by the way. You go with the flow on that. When they start to hike it, just know that interest rates might start to increase. But what we know is that we have some underbuilding. So that's what I'm going to focus on. I'm going to start looking and saying, remember history, what occurred in 2008 through 2012. And I'll tell you, it was a bidding war for investors. So the first thing to do to protect yourself is don't have a lot of debt. That's easy to say right now because debt is so cheap and you're going to be tempted to simply leverage everything. Don't go crazy. Like on a real estate project, I'm not going to say zero, but 50%, 60% max. Like, don't go do the 100% financing and you say, but interest is really low. I remember, I could tell you a real life situation where I bought a house subject to a 2% mortgage. People would still get underwater because even low interest rates didn't mean that it was a good investment. So don't fall for that trap. I never saw anybody get foreclosed on that didn't have debt on their property. So if you want to protect yourself from a real estate crash, make sure that you don't have a ton of debt on that property. I would say, hey, if you can own 7 properties outright, you're not worrying about things, and now you can invest a little more aggressively because you're not so worried about, hey, I'm never going to run out of money. And here's why I say that, because even when we lost 75% of the values here in Las Vegas, my rent still went up on our rental properties. So we've had these properties now. I don't even know how many times they've multiplied their value, because you could buy a house back in 2009 and 2010 for 40 grand and it's worth 400 now. It's crazy, right? But the rents haven't changed a huge significant amount. It's still gone up. Like, we're seeing rental increases consistently, but I'm not so worried about that. I really don't care about the value of the property because I'm not selling it. I care about what it's generating. And that old adage is, again, if I don't have debt, I don't have foreclosures. That's what you do. Now, if you're in this marketplace and you want to make sure that you don't get bit by the, oh gosh, when the economy starts to tighten, people start looking around for money and they may be looking at you. They may say, you know what? You got a tenant who has financial issues. So how do they solve them? They sue their landlord. So how do you protect against that? is you start isolating your assets. Easiest way to look at it is if I'm buying houses and they're all in my name, here's me. I'm so happy. I've got nice properties. Give you a body there so you can actually have one. If something happens, let's say this is 1, 2, and 3. If something happens on property 3, let's say you get a little fire, it's going to come in, it's going to take 1 and 2, and it's also going to come take any other assets I may have. Anything I may have are now in the firing line. So I want to make sure that at a minimum, I'm isolating these guys. My recommendation is to isolate each one by itself, and so that I'm protecting myself and my other assets, including being garnished for the rest of your life. Like, let's be real. People always say, I'll go bankrupt. You want to go bankrupt because somebody's suing you because something happened on a piece of property and you're going to lose all of your investments? Yeah, don't be crazy. We don't want to go bankrupt. What we want to be able to do is isolate that liability so your insurance takes care of it. That's what we care about. But if we didn't have that, there's really nothing stopping them. They could garnish you until you die and then try to take a piece of your estate. So we don't want to do that. We don't want to be in that situation. We want to isolate that liability. There's something called outside liability too, which means we want to protect those things from you. And what kind of things could you do? There's your car. You're driving your car, get into a car accident. Are they going to try to take all of your assets? Hey, I have a bunch of houses free and clear, right? Those are attractive target. You want to make sure they can't get to them. And so we're putting up roadblocks to make it very, very difficult. How deep you want to get into those roadblocks is up to you. Could you create an impenetrable wall? Pretty close, but you could spend a fortune trying to put it in place. What I've seen work is, number one, you have good insurance and you have an umbrella policy. The primary insurance, like let's say I have landlord's insurance and I have a umbrella policy to make sure that there's an extra 1 million, 2 million. You're not going to see too many claims that go north of that, but we're giving them a reason not to keep attacking us. So we want to make sure that we have that coverage. It covers me too. So if I do something, there's a pot of money to make these things go away. And let's be real, 99.9% of the cases get settled. But let's say that you are part of that 0.01 where you just have, Matlock with his ears pointed, put back, and they're just coming after you like demons, and they're like, you feel like they're just zeroing in. You want to make sure that they can never collect on that judgment. You want to make sure that you are in control of these assets. And the way you do that is by using an out-of-state entity. Usually it's Wyoming. I'm putting it in a state where the only remedy they can get is a lien against it. And so we say, all right, here's a lien that potentially, here's mean person. They're mad because you did something to them, or your kid did something to them, or you just got sued in your profession, or whatever. Fill in the blank. And you want to make sure that the best thing that their win is, their number one win is that lien. The only way we can do that is by putting up a nice defensive wall. You're not going to do it, generally speaking, in your typical in-state LLC. So if I have a piece of real estate, let's say this is Indiana, they're going to take that, right? If they sued me individually and I had LLCs that were in my name, it was just me and my spouse or whatever, and they're coming after it, they could actually get to those LLCs and they could force the liquidation and the distribution of the real estate out of it. Most states, there's a few exceptions. The number one exception in my book is Wyoming. Nevada's right there with it. Nevada's just a little more costly. But even single owner entities, like if you're a single individual, they can't take the entity and liquidate it. You can keep them at bay to make sure that there's a lien. And all that does is gives you a settlement ploy. Now, can you elevate this even further? Depending on your net worth and depending on your exposure, you can absolutely put a trust into the mix called an asset protection trust. Personally, and by the way, like a lot of the ratings from folks that specialize in this area, it goes Nevada and South Dakota in that order. Nevada is the number one jurisdiction. We have protections against just about everybody if somebody's coming after you to protect that. Now, that's a little bit of overkill for the vast majority of us. And so you may not want to put that in place right away. There's lots of folks out there that would do it, but that's like bringing a bazooka to a knife fight, right? It's like you're just going a little bit overkill. This is going to solve the issue. And then the secret sauce in this one, realistically, is making sure that they can't see what you own in a public record. So there's lots of videos on my YouTube channel about this topic, but we still want to put ourselves in place so that if there is a crash, what we see immediately is an uptick in the frivolous suits or those borderline suits where somebody's trying to recover money because they are in financial disarray. And a lot of times they look at other individuals to collect from. The biggest secret to overcoming any situation is to A, get out ahead of it, B, to make sure that there's no incentive for somebody to really try to come after you. Like, you don't want them, they're not going to spend $250,000 trying to get something when the answer might not be a dollar. Like, they're not going to spend $250,000 to go after you to get an unknown. If there's a big question mark, like how much am I going to get at the end of the day? It may be zero and there's a big question mark. They're not going to invest $250,000 to $500,000 to get a judgment, to go through supplemental proceedings and to try to squeeze any more income out of you. It just doesn't happen. We've not seen that. Doesn't mean that there might be the one-off. That's why you make sure that you actually have something that protects you. And then if needed, you add enhancement at a time where it doesn't violate the law, but you can still put in other protections as well as part of good business planning. What we don't want is to attract suits simply because there's financial distress going on out there in the world. Now, the last thing that I'm going to say, when you are dealing with something where it falls off the ledge, we have a big crash. And today we're talking about real estate, but I'm going to use the analogy of back again in 2008 when the stock market dropped 38%. It took about 5 years to really get that full recovery back. It did recover, and then it just went on this tear called a bull market where it just continued to go up and up and up and up and up. If you were forced to sell in 2008, you missed out on all of that growth and you were pretty miserable. You probably have lost carry forwards. You're probably like, gosh, bless it. I had to, it's one of those things where if I have to live off of my asset base, so let's say that I am somebody who's retired and I'm following traditional bad advice where they say this 4% rule. So we have this portfolio and you have to sell a portion of your portfolio every year. If they were using that 4% rule, then we just saw you devaluation. You're probably having to sell off 8, 9%, maybe 10% of your entire estate to pay for 1 year. Right? That's how those numbers work. You cut something in half, the 4% is no longer 4%. 4% is now 8%, right? It's double. It's bigger. It's a bigger amount that now you're having to spend. You're like, wait a second, what just happened? I just got myself in a situation where I'm not going to be able to retire very long because the market closed, because you can't do this. You can't say, hey, electric company, how about I pay you when my stocks recover? You can't go up and say, hey, mortgage company, how about I make my payment once the market is going on a bull run. Like I need a few years. How about it's kind of like the old, I gladly pay you Tuesday for a cheeseburger today. They're not gonna go for it, right? You have to sell that stock to pay for it. And that's what we saw. We also saw it in real estate. Somebody who, let's use my example of, here I am in Las Vegas and we're down 75%. So let's say you had a piece of property that was $500,000 and now it's down to $125,000. That would be the value. And I'm having to sell it because I need that money to pay for liabilities. I need to pay expenses. They don't care. Your creditors don't care that the market is just tanking. Everybody's in that same boat. It's tanking because everybody's selling and you don't have enough buyers, right? So they're like, That's exactly what happened. You ended up having to sell things, and there was plenty of folks like me that were buying it because we're liquid, and we're like, hey, I would love to pick that up. Like in a selfish way, you're kind of like, wow, I remember those good old days. I like picking stuff up. No, like if you want to make sure that that is not you, that you are not in the situation where you're forced to sell, then you buy things that have cash flow. You buy assets, not liabilities. And this is a very, very important concept. You buy things that have positive cash flow. You don't go out and buy a house and spend a ton of money so that you're having to service that debt. And after you collect all your rents, after you pay for the property manager, after you pay for the insurance, after you pay the real estate taxes, after you pay for repairs, that there's not enough to cover the debt service, just the interest on it. You do not do that. That is not going to be you. You need to make sure that after all that's done, you have positive income, that no matter what you're doing with that property, that it's putting money in your pocket every month. Then you're not in a situation where you're going to be forced to sell it if the market goes down. Everybody who did not sell in 2008 recovered. Everybody, whether it be real estate, whether it be the stocks, if you were able to wait, you recovered and then made monstrous gains. Not just okay gains, monstrous gains. We've never seen a run quite like this. You're averaging about 13% growth in the last 10 years. It's been really, really strong. Even with the pandemic, you saw massive growth. Even now, we're sitting here in inflation, and inflation pushes up. Guess what it pushes up? Equities, because it's growth and inflation that drive equities up, and real estate. There's not enough of it. There's lots of people out there looking for a very small number of properties. And that's probably anywhere you are. If you're in a major city, that's what you're living through, except maybe some in California and in New York. And I'm just teasing you guys. Even there, we're still looking at big prices. Like you still had a monstrous run since the recession. And so that's what you need to have in your portfolios, things that are paying you throughout the time. So you're not forced to sell something when it's been devalued. A wise man once told me, and I'm going to use this as a really good example because this is God's honest truth. When I was in Seattle, I lived in Seattle for a couple decades. One of my friends was a professional baseball player who then went into financial services. And he worked in a company that worked with a lot of professional athletes. What he said was the folks that were managing the portfolios would say to the players, don't look at your portfolio every month. Don't. It's kind of the old adage where I tell people as a joke, hey, put a bunch of good stocks in your portfolio and then lose your password for 20 years, like log in like once every 20 years and you'd be pretty happy. And he would say, like, don't go look at your account because it's going to make you do something you don't want to do. If it's way up, you're going to be like, we should sell. If it's way down, you're going to say, we should sell. When the correct answer is let the portfolio do what it's designed to do, which is produce income. And so they would say, look at the income that's going into the account. Don't look at the value of the account. Make sense? If I buy a bunch of rental properties, I buy 10 rental properties and I spent X for them, I don't care what that number is. Is it X minus 10%? Is it X plus 10%? I don't care. What I care is what is it producing? What's Y? The cash flow. I don't care about X. Like I don't have a ticker signal over my house. I don't want a ticker signal over my house that tells me what its value is every day. Because I come home and I'm in a good mood and I'm saying, oh, it's gone down. Or I come home and I like it's up. Oh, maybe we should sell. I'm not going to sell my house. I don't want to sell my house, right? I want to live in it. If I have rental properties, I don't want to sell my rental properties. I want to get cash flow from them. That's why I buy it. I don't care what the value of it is. It could be $1 million, it could be $10. It doesn't matter to me because I'm living off the rent. You got to divorce yourself from that number. And if there is a correction in the real estate market, guess who is sitting pretty? Raise your hand. You are sitting pretty because you have cash flow real estate. You're not stuck with a bunch of debt. And if you do have any debt, it's moderate debt and it's being covered by any of that cash flow. And you're sitting there going, yeah, this isn't really going to affect me. There's going to be great opportunities. Because as Warren Buffett said, when others are fearful, be greedy. When others are greedy, be fearful. That's actually a really good quote. If that's all you ever did is just said, hey, you know what? I'm not going to buy when everybody's super excited. I'm only going to buy when everybody is like doom and gloom and the market's getting killed. You do really, really well. Like, so you're going to look around and say, everything's on sale. I'm going to buy good companies on sale. I'm going to buy good real estate that's on sale, good cash flow. And I'm going to just make sure that I'm never too worried about the hype. I'm not buying at the height of the market. I'm not chasing things. I'm just buying things that produce cash flow. And then I forget what I paid for them. You know, that's the best thing about real estate is it makes you look really smart after 20 years because you can say, oh yeah, I bought this. Like tomorrow you're going to say, oh, I bought this thing for $200,000. And everybody's going, oh my gosh, you paid $200,000 for that. But it's producing this great income stream, right? But nobody cares about that. They just care, like, what did you buy it for? What is it worth now? Right? You could just make up whatever you want in 20 years. I don't remember what I bought it for. Probably like, 20% of what it's worth now, maybe half. Or you could be one of those guys that says, man, I bought it and it sucks, but the thing's paid for itself twice, since I bought it. That's what you want. You want to have that constant stream of income so that over a period of time, like let's say 7% growth, that means that you paid for that property more than likely if it's producing a 7 cap. You've paid for it every 10 years. It's paid for itself. Yay. Right? That's what we want. We want to have these nice cash flow properties so that it's buying itself, so that it's not really, hey, I didn't even have to pay anything. It's giving me back everything I ever put into it. And now it's just a cash machine. It's just spitting out cash every month. That's what you want. And that'll protect you if there is a correction in the real estate market. Because here's the thing, people need a place to stay. The one area that has not seen just crazy growth, low to moderate income housing. It's because we are so short on it. There's not a ton of it out there, which means that there's still opportunities. I love that area of the market because it is a cash flow cow, like mobile homes, manufactured housing, shared housing. I think those things are all going to be big because as things tighten, people still need a place to stay no matter what. If you like this type of information, please share it with others. Please subscribe. Please click that like button so we know. And more importantly, is if you want me to dive into any subjects and do a deep dive, let me know. Put it in the comments down there and just let me know. Here's something that I would like you to cover at some point. Have you ever looked at this or that or the other, or ask me to clarify? Because you guys and your questions are what we're really here to answer. And it makes our site so much better, it makes our YouTube channel so much better, and it gives me something to do. Thanks, guys.